Let's move on to Kenya. Raila beats rivals to a new deal, says Africa Confidential. The opposition is in disarray after its erstwhile leader signs a surprise agreement with President Kenyatta. It was a most ambiguous of handshakes, they say. It served a clear enough purpose, it dampened down the confrontational political mood and boosted the economy. Within hours of the handshake, the shilling strengthened and the Nairobi Stock Exchange Index edged higher. Well, it's at a record every day this week. The governing Jubilee coalition choreographed it expertly. The optics, two smiling rivals now apparently reconciled, pointed to a grand new political arrangement, even if none of the practical details were spelled out. 2 hours after the handshake, the United States Secretary of State, Rex Tillerson, landed in Nairobi. Any questions he may have had about political reconciliation and national stability would be met with that day's headlines, the big handshake. Under the terms of the deal discussed, we hear that Odinga will have a plush government office at Jogo House next to Kenyatta's set up at Harambee House, the obligatory ministerial Mercedes 500 with security and motorcycle outriders. Saying it's also freed him from pressure from his top three associates in the opposition, NASA, Wycliffe Musalia Mudavadi, Stephen Kalonzo Musyoka, and Moses Simiyu Wetangula, had been secretly negotiating an alliance with Kenyatta in their own right. They also repeatedly threatened to defect from NASA unless Odinga renounced all ambitions to run for the presidency in 2022 in favour of one of them. As a top Odinga advisor told Africa Confidential, now he has beaten them at their own game and caught them by surprise. They were joyriders in a Raila-driven party. Saying the biggest losers are Mudavadi, Musyoka, Wetangula. The once sure of its position close to Jubilee, ODM began to distance itself from NASA, removing Wetangula's Senate Minority Leader on March 15, replacing him with James Orengo. The trio now say that they want to negotiate their own agreement with Kenyatta, but for now they are marooned politically. Yet, as often happens with Kenyan politics, that could all change next month. My piece on the 12th of March dealt with this exact issue. It was called the Rapprochement. If Kenya did get a loan to build a railway, or vice versa, asked The Economist. When Kenya launched its new railway last year, connecting the coastal city of Mombasa to Nairobi, passenger tickets sold out. Travelling between the two countries' two biggest cities overland had meant crowding into a bus for 12 hours, or riding the old British-built railway, which might have taken 24 hours. The new line, run by Chinese engineers who wander up and down the carriages, has cut the journey to between 4 and 6 hours, depending on the number of stops. The seats are comfortable and at just 700 shillings affordable. Lucky passengers see elephants along the way. Shuttling passengers, however, is not what the new line was built for. When Kenya borrowed $3.2 billion from China for the railway in 2014, the aim was to move freight efficiently between the capital and the port of Mombasa, 484 kilometers apart. Unlike the passenger service, the cargo one has been a disaster. The second train out of Mombasa arrived a day late because it didn't even have enough goods to leave the port. Passengers may find the biggest elephant on their journey is the white one they are riding. In 2013, the World Bank said that new railway would be feasible only if it were able to move at least 20 million tons of cargo a year, just about everything that goes through the port. At best, the new line will transport half of that. Some fear that it might not make enough to cover its running costs. If the authorities then skimp on maintenance, the railway could deteriorate quickly. Before the new line, Kenya already had a functional railway, the old British one. In the 1980s, it moved about 5 million tons of cargo a year. It could have been refurbished for perhaps a quarter of the cost of building a new one. But that would not have come with a big Chinese loan or the cash that was splashed out on subcontracts and the land purchases needed for the new line. Some cynics in Nairobi said that building the railway was a way to get a loan rather than the other way around. Now let's look at some earnings that come out of the Nairobi Stock Exchange. Let's start off with Dr. James Mwangi's Equity Group, which reported first full year 27 earnings per share increased 14.155%. Their holdings of government securities clocked 128 billion, up 27.252, Customer loan book was up 4.895% to 279 billion. Total assets 524.46 billion, up 10%. Government securities income, obviously that was going to be up 69.925%. Full year operating income was up 1.763%. Their loan loss provision was against the grain because they cut the provision as opposed to everyone else who's typically was slightly higher, down 48.367%. Total operating expenses down 2.115%. Full year profit before tax up 7.845%. Full year profit after tax up 13.947%. Earnings per share up 14.155%. Dividend per share unchanged 2 shillings. They're obviously conserving cash because of the new IFRS 9 regime. Kestrel said net interest margins at 8.5% were higher than our estimates of 8.2%. NPLs declined from 7.4% to 6.3% in Q4 2017, a notable improvement, especially if you look at the trend in NPLs going up to even February 2018. If you're interested in the press release, that link is on Rich Wrap-Ups. If you're interested in the investor presentation, that link is on Rich Wrap-Ups. James Mwangi, we believe that the future of banking is predictive capability, and this is where we have set up our eyes as a group, he said. Equitel transaction volumes grew by 11% year on year. Equitel transaction value grew by 32% year on year. Regional businesses, Uganda profit before tax grew by 88%, Rwanda by 76%, DRC by 55%, South Sudan by 107%. Strong. A double-digit growth across the subsidiaries with an increased contribution of PBT of 14% from 8% year on year. Have a look at this from Rich TV Africa, giving you the results in a pictorial image. Added 1 million customers in 2017. Total customers are 12.1 million. 96% of all transactions are outside the branch. My conclusions. The pivot to government securities tapered the NPL ratio by 430 basis points, apparently. Subsidiary contribution is set to accelerate further, in my opinion. They will probably move very quick once the caps are modified to liquefy what remains a key franchise of the bank. These are, in my view, strong results which promise much. And I leave you with the comment that Dr. Mwangi left us with. 2018 is promising, and hence we're very optimistic this year, he said. Let's remove or scrap the regulation. There's nothing to think about. We all know it's headed in the wrong direction. Talking about the rate cap. He also said that he has $2.1 billion for lending once the rate caps are removed. Standard Chartered reported full year 2017 earnings. The share price is up 3.846% year to date. Let me take you through their numbers. Profit before tax was down 24.208%. Profit after tax was down 23.595%. Earnings per share down 24.023%. Dividend, they marked down 15% to 17 shillings a share. But that's worth 7.87% in yield terms on the current share price. Underpinning it, it's had a big move today. Look, those results were significantly better than everyone expected because Standard Chartered had been very conservative and warned, but had issued a full year's profits warning, and people were expecting it to be around the minus 30% range. Kenya government securities, they've got 103.48 billion. The loan book to customers grew just 2.92%. Total operating income was down 2.312%. Loan loss provision, they increased by 90.262%. You see, that's against the equity. You compare that to equity. You already know the core numbers. Earnings per share was down 24%. So the dividend is worth 7.87% on the current share price. They had warned last year. I think they've re-optimized the balance sheet. and end 2018 will see a very significantly strong set of full year earnings, in part because they will be lapping a soft 2017. They had to play defense in 2017, evidently. This is some photographs, some art from the executive floor at the Standard Chartered Bank, just not too far from here. NIC Bank reported full year earnings per share declined 4.284%. Loans and advances to customers expanded 4.625%. Total assets were up 21.665%. Interest expense up 11.523%. Total operating income down 7.722%. Profit after tax down 4.295%. EPS down 4.284%. Final dividend 1 shilling a share, which means they actually cut the dividend payout because they paid an interim last year. And they've announced a 1 for 10 bonus issue, which will keep it supported. So basically, it's trading at a PE of 6.25 and a price to book of 0.7. They are clearly a tier 2 outperformer, and 0.7 price to book looks very inexpensive. The bonus will underpin the share price. It's an attractive higher beta prospect. They had to play defense in 2017 and played it effectively. 100 million shillings is traded weekly in Bitcoin in Kenya. This is John Karanja, the founder and consulting lead at BitHub Africa. BRITAM reported full year earnings per share was down sharply, down 79.635%. It is down as a share, down 3.37% year to date. Full year gross earned premiums, that was up 14.81%. They reported a net loss income from investment property, a net loss of 607.26 million versus plus 991 million previously, so that's interesting. Insurance claims, that was up 22.66%. Profit before tax was down 79.575%. Earnings per share down 79.365% at 26 cents a share. They're paying 35 cents a share dividend. That's an interesting development. Total assets were up 18.39%. They're saying that, total comprehensive income was up 143%, and total income was up 24%, and that they're talking about this gross premium valuation method versus net premium valuation. Impact of this in 2017 is an increase in net insurance benefits by 150%. Assets under management was up 18%. Regional businesses contributed 2.7 billion shillings. Equities returned fair value gains of 3.4 billion shillings compared to minus 3 billion in 2016. Investment income from dividends and interest was up a whopping 19% to 5.1 billion. Stripping out the effect of the change of methodology from NPV to GPV, it was in fact a strong performance. The adjustment in real estate was interesting, the NSE rebound was material. Kakuzi reported full year earnings per share increased by 5.192%. The share price is up 9.422% year to date. Full year sales were up 6.515%. Gross profit up 3.832%. Profit before tax up 12%. Profit after tax up 5.195%. Earnings per share up 5.192%. Dividend per share up 16.667%. Pre-tax profit of 849 million shillings versus 759 million shillings last time. Increase in profit as a result of continued market demand for avocado and macadamia throughout the year. Profitability within the tea operations continue to reflect the difficult trading conditions and significant inflationary pressure on labour and other production costs. Final dividend 7 shillings a share. They are in a sweet earnings spot, in particular because of an early pivot to avocados in the 21st century millennial economy. Have a look at my article, The Crypto Avocado Millennial Economy. This is segmental reporting. Avocado sales constitute 64.332% of Kakuzi's total sales. 22nd of January, I wrote about the millennials with their avocado eating and cryptocurrency trading ways are just as likely to be African as they are European or American. Kenya Airways would benefit from the political handshake dividend, I told the Financial Times. The last thing I would say is we're out of trouble, Mr. Mikosh. This is Kenya Airways. It will take another 2 years of growth and cost control before we can say we're more optimistic. I said Kenya Airways would benefit from the political handshake dividend, but said I was still concerned about its short-term prospects. I don't think Kenya Airways has been left with financial firepower to take on the competition and expand where they need to. I'm talking about the balance sheet. I think the banks took it. Kenya Airways, this is a tweet from Mr. Sunil Sangha. KQ results not available on your website and those circulated through. Pages missing include the statement of financial position, the balance sheet. Uber denies report it will test unmanned flying taxis in Kenya. Kenya's largest companies by market cap: Safaricom 1.23 trillion, EABL 201 billion, Equity Bank 198 billion, third, KCB fourth 153 billion. Then we go to Co-op Bank at 112 billion, which is fifth, Stanchart 73.5 billion, sixth, BAT 7 72 billion, 8 Barclays 67 billion, Bamburi 9th 65 billion, KQ 10th, 64.5 billion. Nairobi All shares up 11.96% year to date. It's